Are you prepared to advance your Bitcoin investments and profit from ongoing price fluctuations? Who wouldn't find the thought of purchasing cryptocurrency in one location and then selling it for a profit in another appealing? Crypto arbitrage is definitely going to look like an appealing prospect. Crypto arbitrage can literally mean creating money out of thin air when done well. However, if done incorrectly, it might result in significant losses, so be cautious before moving on. If you're keen to learn more, we'll discuss what crypto arbitrage is, how to do it, and if you're likely to pull it off profitably. Keep in mind that arbitrage is different from researching and then investing in cryptocurrency for the long term. How does crypto arbitrage work? Crypto arbitrage is the practice of purchasing cryptocurrencies on one exchange and then reselling them for a profit on another exchange. Since there are numerous cryptocurrency exchanges available, this procedure is made possible by the fact that their prices vary according to their liquidity and how quickly they adapt to market pricing. For instance, if you purchase one Bitcoin on Binance for $42,000 and sell it on Wobi for $42,500, you will have made $500. Given that most platforms take a cut, a profit this high is actually improbable, but if you're savvy, you can definitely make something. We'll explain how soon. Since you are taking advantage of price disparities across exchanges rather than price changes over time, arbitrage is different from other trading methods. As an aside, cryptocurrencies aren't the only thing that cause this occurrence. Foreign currencies, equities, precious metals, and other assets can all be arbitraged. Arbitrage has been practiced for ages. Nevertheless, because the cryptocurrency industry is more recent and less developed than more established assets, you can have it simpler with cryptocurrencies. The prices of lesser exchanges are greatly influenced by a select few large exchanges, which adapt more slowly. Arbitrage types. You should now get the gist of it. You may not be aware, though, that there are a few distinct varieties of cryptocurrency arbitrage, each of which functions slightly differently. Yes, you read it correctly. We're throwing you a curveball just when you thought you understood everything. Make sure you understand how the following differ. Spatial arbitrage. In this strategy, you buy cryptocurrency from one exchange and then instantly sell it on another for a higher price. Arbitrage based on convergence. In this case, a coin purchased on one exchange is short-sold on another. When the prices of the two assets converge, the arbitrager closes both positions. Trade across many trading pairs is required in the most complex arbitrage approach, known as triangular arbitrage. Soon, we'll go over each step in detail. How comes arbitrage possible? Do you find the concept of arbitrage to be a little strange overall? You're not the only one who finds it difficult to imagine paying different costs for the same thing in two distinct locations, or more than two. Consider it this way: arbitrage is mentioned as a strategy to make markets efficient in economics textbooks. According to the theory, people will arbitrage when markets are inefficient until prices eventually self-regulate and become uniform. Although this is questioned by the reality that many people may profit from arbitrage consistently, it's still a good concept. So why is crypto arbitrage still feasible in a world when we should have perfect knowledge because of the internet? Here are a few possible justifications. Variations in liquidity. Depending on how many individuals purchase or sell an asset on each market, the liquidity level varies. This will inevitably differ between exchanges, leading to various prices, higher prices when liquidity is limited. Not all exchanges that trade cryptocurrencies target the same investors or nations. This might have an impact on prices. Times for deposits and withdrawals. Slower processing exchanges have a harder time catching up to the overall market rates, often smaller exchanges. Currency conversion rates. If you're extremely clever, you could even be able to make money by purchasing cryptocurrencies at one exchange rate and selling them at a different one, securing a profit if they are substantially cheaper in one currency. If none of this makes sense to you, don't panic, arbitrage is still possible. How to use cryptocurrency arbitrage. Crypto arbitrage theory is one thing, but putting it into practice is another. Recall that we previously stated that there are three basic categories of arbitrage: triangle arbitrage, convergence arbitrage, and spatial arbitrage. Although there are some commonalities among the approaches, they all operate somewhat differently, so we'll go over them one at a time. We'll also include some details on building a trading bot as an added bonus. Spatial arbitrage. If spatial arbitrage is your choice, you will purchase cryptocurrency on one exchange, move it to another exchange, and then sell it on the other exchange. If you like, you can avoid needing to transfer your cryptocurrency by completing the purchases concurrently on both exchanges. Although it is the simplest approach to comprehend, there is still a chance of failure. To increase your chances of making a winning deal, you'll need to be careful to leave a margin of error, also known as a reasonable difference between the price you hoped for and what you buy/sell for. Remember to account for withdrawal and deposit fees, lengthy processing periods, and potential technical issues as well. And move swiftly. If you don't lock in prices now while you still have the chance, you risk losing out because they are always fluctuating and adapting to the market. Arbitrage of convergence. A long/short deal is involved in this kind of arbitrage. In this case, the arbitrager purchases underpriced cryptocurrency, long, while simultaneously selling cryptocurrency, short. You can sell your long position and repurchase your short position when the two prices meet in the middle. But how am I expected to determine whether a cryptocurrency is overpriced or underpriced, you might be asking. Consequently, you are not a fool. This method's main drawback is that it can go wrong and is inherently riskier than the others. However, you are not required to have a viewpoint on whether a specific cryptocurrency is worthwhile to purchase. The only choice is whether the price will rise or fall in relation to the other. If you're astute, you might understand that even if the market crashes, you might still profit by being short on one side of the transaction. Only if the fall on the short trade is greater than the decline on the long trade, though. Arbitrage in triangles. You simply just need to conduct a more complicated version of the aforementioned approaches by moving between 3 distinct cryptocurrencies instead of just 2 if you choose the even more involved triangle arbitrage. The first issue you'll encounter is how challenging it is to evaluate the profitability of 3 distinct cryptocurrency price comparisons. Fortunately, there is a formula that you can utilize, which is as follows. The volume of your trades, first pair's exchange rate divided by third pair's exchange rate equals X. You should be profitable if X is greater than the amount you intend to trade, net of commissions. However, always allow for error. How to create a Bitcoin arbitrage bot. We have excellent news if you think that meticulously examining every exchange and figuring out how much profit you can make after deducting fees sounds tiresome or impossible at worst. You can create a trading bot to perform the work for you rather than doing it yourself, but if you're not a developer, you'll undoubtedly find this even more challenging. Cryptocurrency arbitrage bots track many exchanges and automatically notify you when prices reach the desired levels using APIs, software that connects various computer applications. To achieve this, you must first locate the API for each exchange, or, if you want to follow numerous exchanges, for a cryptocurrency tracker like CoinGecko, and then run the application using your preferred programming language, usually Python or JavaScript. If you don't feel the need to build it yourself, you might be able to find a crypto bot someone else has already created, in which case you'll only need a basic understanding of how to utilize programming languages. We suggest reading this comprehensive tutorial for setting up a trading bot if you want to learn more. Is Bitcoin arbitrage lucrative? Arbitrage in cryptocurrencies can undoubtedly be rewarding. There will always be a method to generate money as long as pricing discrepancies exist, which they most certainly do. However, that does not necessarily imply that it is simple or the best option for you. Before moving forward at full speed, keep the following things in mind. As we have already shown, it's not just the price differences across exchanges that count, transaction fees also play a role. These may not be a big concern for long-term or even short-term traders who aim to time the market and earn significant profits, but anyone attempting to engage in arbitrage is dealing with thin margins. Keep in mind that even small costs might add up. The reality of arbitrage isn't always as appealing, despite the fact that the theory is fantastic. You never know when an exchange will abruptly freeze, shut down, or whether you'll be caught off guard by technology. This is why it's crucial to allow for error. Arbitrage is less dangerous than many other forms of trading, yet, on the other hand, while you won't always make a large profit if you purchase and sell cryptocurrency at the same time on 2 different exchanges, you usually won't lose much money either. This makes it a fantastic option for anyone who doesn't want to take the chance of holding money for a long time in the unstable cryptocurrency market. Crypto arbitrage, is it legal? You didn't really believe we'd be writing a lengthy piece about cryptocurrency arbitrage and how to accomplish it, did you, my friend? Taking advantage of price discrepancies is legal, despite what individuals who have never done it may think. Some would argue that maintaining efficient markets, which make prices fair for everyone, is a good and important job. Cross-border arbitrage, trading between two countries, will require a little more caution, though, because each country has its own regulatory and anti-money laundering procedures. Although you might face a little more scrutiny from financial institutions and you might not be able to open accounts in some nations, this does not make what you're doing unlawful. Always move with caution. Let's eliminate flaws from the markets. Crypto arbitrage has never been characterized as a get-rich-quick scheme, but it is also not the riskiest or wildest trading method available. Not as much can go wrong as some other crypto trading tactics if you know what you're doing and you trade a very minimal amount that you can afford to lose. In addition, you'll be performing the honorable duties of promoting efficiency and assisting in the elimination of market mispricings. What else is there to ask for?